Hi there, it's Dave Keller here with Market Misbehavior. Today I'm going to talk to you about a price pattern called the deadly descending triangle. Now I'm using a pretty aggressive adjective here with deadly, but the label descending triangle has a particular definition to it, right? The idea is after a run higher, you have sort of a sideways consolidation pattern of sorts with a sort of flat support level and a descending level of resistance, right? So you can draw a trend line off of the highs, but the lows are not a trend line going higher, which would be a symmetrical triangle, but it's more sort of flat, right? It's a level of support. So what happens is you have a rally higher, then you keep bouncing off support, and think of it as a ball that keeps falling down and you keep bouncing lower and lower. From a technical perspective, usually the end of that is not just it stops, but because the stock continues trading, that lack of demand usually pushes the price much lower. And breaking below that support level is usually a really negative sign for a stock. I'm going to show you an example in a weekly chart of Danaher, this descending triangle pattern, what it means, how it's formed, and what the recent signal might suggest to you. Before we get there, by the way, if you like this sort of thinking about technical analysis, market dynamics, investor psychology, I hope you'll subscribe to my channel. Also, give the video a like if you appreciate it. We'd very much appreciate that back. Put a comment below, bullish or bearish on DHR and other medical equipment names here. Why or why not? Let me know in the comments below. All right, so here's the weekly chart of Danaher, DHR. We're going back for the last 5 years. Now, overall, through the end of 2021, pretty consistently strong chart. Now, how would I define that, or how would I label that as a strong chart? Well, the price continues to make higher highs and higher lows fairly consistently through that period, with a notable exception in the first quarter of 2020 when sort of everything was coming off in the COVID sell-off. Other than that, consistently above the 40-week, and that equates pretty closely to the 200-day moving average. Continue to make new highs all through that period until stalling out at the end of 2021, and well above an ascending 150-week moving average through that period. On an unadjusted basis, and what that means is we're basically showing the actual price data over the period of time, which on a longer-term basis, depending on what kind of question you're trying to ask, that's probably the best way to do it. And on an unadjusted basis, basically we're just adjusting for splits or any sort of capital change in the stock. And if you look back over time, we've been above the 150-week moving average since 2017. On an adjusted basis, which means you do adjust the history for dividend payments, 2011, we've been above the 150-week all the way since 2011. So either definition, we've been in a pretty good uptrend for quite some time. Look at how the picture changed as many pictures changed at the beginning of 2022, almost like we flipped a light switch from bull market phase to bear market phase. All of a sudden, higher highs to lower highs, higher lows to lower lows, above an ascending 40-week moving average to below a descending 40-week moving average. And all of a sudden, the 150-week moving average finally comes into play when we are nowhere near it. Also, look at the momentum characteristics, right? The RSI consistently remaining above 40 again, with that notable exception in March of 2020. But other than that, consistently remaining above an RSI level of 40, the RSI often becoming overbought on upswings, on impulse waves, and that's pretty characteristic of a bull market phase. All of that changed when we got to 2022. Look at how the rallies, these counter trend rallies, never really pushed above an RSI of 60. In a lot of cases, not even above an RSI of 50. So it shows you how we shifted from a bull market accumulation phase to more of a consolidation or bearish phase. Look at what has happened over the last year and a half, and this is what's called a descending triangle pattern. So a descending triangle pattern, again, is it's a price pattern. It's a visual pattern where you have a descending trend line tracking the highs. So I'm connecting the high from December of 21 with August of 22 and with January of 23. And look at how well those highs line up pretty well. You can see that continues on through today. And then we have a fairly steady level of support. So a symmetrical triangle would be lower highs and higher lows, right? And sort of a narrowing of the range. Here we also have a narrowing of the range, but the bottom line, instead of being a trend line going higher, it's actually a flat support level. So we keep bouncing off this $240 level once, twice, 3 times, 4 times, really close, 5 times. Finally, the 6th time is where we actually sort of start to break through it. Even a bounce off in the 7th time is when we finally plunge through there. So the general way to think about a descending triangle pattern is it, of course, has to come to a natural end because the triangle will end at some particular point called the apex, usually about 2/3 to 3/4 of the way through the pattern. John Murphy taught me years ago that is when you most likely have a breakdown. So we're about there. If you think about the shape of this pattern and how close we are to the end of that pattern, we're about 2/3 of the way through, and that is pretty much when we normally break down, which we now have. That's why I would argue that this recent breakdown in DHR is not just a short-term breakdown, but probably more likely a longer-term breakdown. And the reason why you can define that is because this descending triangle, this consolidation pattern now broken. Now look what has happened. We now had a clear level of support around 240. That has now failed. We're well below those levels, currently around $15 lower. We've exited this pattern now to the downside, and now we're below the 150-week moving average. The RSI just below 40, and if that would continue lower, it just further confirms the deterioration that we've seen in price. So how do you play this sort of pattern? I like to think of price patterns in three parts: the setup, the trigger, and the confirmation. The setup is when you can track that this is a potential descending triangle. We're seeing lower highs and a flat support level for the lows. The trigger is when we actually exit the pattern, which is what we saw here, I would argue, last week when we broke through to the downside. That third piece is confirmation or validation, some sort of follow through. And I would say what we're seeing so far this week certainly appears to be a follow through to the downside. We continue around this current level through the end of this week. We don't see any sort of big counter trend rally to the upside. Overall, I would argue that validates sort of this bearish thesis. Now, how do you measure the objective using the descending triangle pattern? Pretty classic technique that Edwards and McGee actually popularized in one of their books. What you essentially do is take the height of the pattern. There are different ways we could take that point, but I would take this point, which actually defines the height of the pattern around 25, 26%. You take it from the breakdown level, and I'm sort of fudging it a little bit. I'm not using the most exact measurements. I don't think you can measure these exactly anymore, to be honest with you. If you take the height of the pattern and subtract that from the breakdown level, that gets you a downside objective just below $180 a share. That would be a reasonable downside objective given the height of the pattern, the time frame, the range of this pattern, and the potential downside given how long and sort of the nature of this basing pattern that we saw at the peak. Now, is there a guarantee that we're going to get there? No, but the general sort of back of the envelope, what downside risk could I expect given this breakdown? That gives you a reasonable downside around 180, just below there, as a potential move to the downside. So how do you, what would be the signal that this sort of pattern is wrong? Well, I think it depends a little bit on how aggressive you want to look at a chart like this. If you're more of a contrarian investor, I'd be looking to see when the RSI becomes oversold. If you look, in March of 2020, a lot of stocks became briefly oversold on their weekly chart, or very close to that. That often can indicate, certainly on a weekly chart, a potential, at the very least, counter trend bounce to the upside. So that might be something I would look at. Also, the PPO or the MACD indicator on a weekly or a daily basis can be helpful for identifying a short-term or long-term rotation back to the upside. If you're more conservative, maybe wait to see when we get back above moving average resistance. We're now well below the 40-week or the 200-day. Can we get back above the 200-day? Can we get back above this trend line, right? How bullish is this chart until we get back above this trend line? I would argue it's still pretty much in a downtrend, arguably, until we get back above that trend line resistance. So there you have it. Those are a couple ways to think about Danaher and think about that descending triangle pattern, what the setup is, how it becomes very clear on the weekly chart, why we identify that support level and a break of the support level as a key trigger, sort of initiating that pattern or confirming that the downtrend phase is most likely in place. What do you think about this take on Danaher? Do you agree or disagree, and why? Let me know in the comments below. Thanks so much for watching. For Market Misbehavior, I'm Dave Keller. Take care.